On 10th of May, Prime Minister Narendra Modi appealed to Indians to work from home, carpool, use public transport, cut gold purchases, and limit foreign travel. All this to reduce pressure on India's foreign exchange reserves. Following that announcement, terms such as current account, capital account, forex conservation, and balance of payments have dominated the headlines. Let's understand what they mean and how they are all connected. Every country keeps a record of money flowing in and out from the rest of the world. That record is called the balance of payments or BOP. When foreign currency flows into India through exports, investment, or remittances, it's an inflow. When it flows out through imports, overseas travel, or investment abroad, it is an outflow. The BOP has two main parts. The first is the current account. This tracks regular transactions such as goods, services, remittances, and income like dividends and interest. If overall dollar outflows exceed inflows, India runs a current account deficit. According to RBI, India's current account deficit stood at $13.2 billion or 1.3% of GDP in the October to December quarter of FY26. The previous quarter, it was $11.5 billion. The second part is the capital account. This records investment flows, foreign companies investing in India, overseas investors buying Indian stocks and bonds, and external borrowing. So if India runs a current account deficit, that gap must be funded either through capital inflows or by drawing on forex reserves. Since the 1991 reforms, India has mostly managed this well. Capital inflows have often exceeded the current account deficit, keeping the overall BOP in surplus. But that balance can shift, and when it does, the rupee feels it first. BOP affects the rupee through simple supply and demand for dollars. More dollars coming in, the rupee strengthens. More dollars going out, the rupee comes under pressure. The RBI may sell dollars from its reserves to stabilize the currency, but that slowly erodes the buffer. Global oil prices, interest rates, and investor sentiment also move the rupee, but BOP sets the underlying direction. Now this brings us back to Modi's appeal. In FY26, India's oil import bill stood at nearly $135 billion. Gold imports reached around 721 tons, worth close to $72 billion, up from roughly $58 billion the year before. Together, crude oil and gold consumed over $206 billion in foreign exchange in a single year. Every time these imports rise, demand for the dollar increases, the current account widens, the rupee weakens, and everything else, from fuel to food, becomes more expensive. Forex reserves are the RBI's emergency cushion to defend the rupee. When the rupee comes under pressure, the RBI sells dollars from its foreign exchange reserves to stabilize the currency. But reserves are not unlimited. If India keeps spending dollars faster than it earns them, that cushion thins out. And that is exactly why the government is now talking about conserving forex. Follow Business Standard for more stories.